Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, May 5th, 2025. Well, last week, as we had previewed, tons of economic information in contrasting fashion. Some good, some bad, some neutral, but an awful lot to go through. We'll start with the JOLTS job opening, which was reported last Tuesday. It was expected to come in at 7.5 million jobs still open. That shrank dramatically. That came in below 7.2 million. So that was not a great start for labor, an indicator on labor last week, but after that, it became much better. The next day, ADP, their employment survey, was expected to come in at 115,000. Not even close. 62,000 was the actual number. Now, we'll talk about the Fed number in just a little bit, but that certainly had the market a bit on edge. But the same day, we also got some favorable, mostly favorable, I would say, inflation data. So the PCE and core PCE was released. The headline number was expected to come in at 2.2% year over year. Increase, it came in a little higher, 2.3, but the core number was actually better than expected. It was expected to come in month over month at 0.1, came in flat, 0.0. So that was favorable. Then personal income, personal spending, both of those metrics for the month of March exceeded consensus expectations. Last Thursday, again on the job front, labor front, initial jobless claims worse than expected. Now, this is held in extremely well, much better than we would have guessed, but it did come in worse than expected. 241,000 actual initial jobless claims, 224 was the expectation. So if we cut it off there, we would say that was kind of a bleak week for labor markets. But the next day, we got non-farm payroll on Friday. Expectations, 130,000. It came in at 177. So that was a great beat. Now, they did adjust the month before down as well, kind of what we saw most of the last 4 years. So that's not great, but still net over the 2 months, it was better than expected in total. So the unemployment rate was static, 4.2% after 177 new jobs, 177,000. Average hourly earnings also came in. It was decent. A little below expectations. Month over month expected to be at 0.3, came in at 0.2. So the biggest news during the week was the GDP number that came in. GDP, and it was announced for the first quarter, and we've spent a lot of time, almost every week, looking at the Atlanta Federal Reserve's expectation. So the expectations for first quarter GDP kept coming down. It didn't look favorable. Concerns about tariffs. So the number came in, was reported on Thursday last week, and GDP negative for the first quarter, negative 0.3. So the headline number obviously looks not great, looks bad. However, when you strip away some of the anomalies from the tariffs, I would argue this is a very much stronger than expected quarter. So tariffs, no question, tariffs impacted the first quarter. First, I should probably mention retail sales during the quarter started off in 70% of GDP, consumer spending. So in January, retail sales were down slightly. February up about the same amount they were down in January, and then we had a very strong March, what we've already reported. So retail sales looked pretty good for the first quarter, but again, the expectation was there were going to be headwinds because of tariffs, and there definitely were, but the composition, I think, is probably different than many would have guessed. So with all the tariff discussions and concern, what happened, it appears, in the first quarter is consumer activity was actually strong. I mentioned retail sales. It's one metric of it. There are others, but retail, consumer spending, strong in the first quarter despite consumer sentiment being down. But the big negative to that GDP number, that negative 0.3, was due to a drag from tariff-related net exports. So it's really the amount of goods that we imported in the U.S. And this is stunning. Haven't ever seen this before. The amount of imports in the first quarter were up 41% year over year. So if you take out the net export factor, so consumption plus investment, and just take a look at it in government spend, you take a look at those three factors, actually up almost 4.5%. So net exports really hurt the market, but otherwise economic activity was much stronger than expected in the first quarter. Now, because of tariffs, again, we may have borrowed from the second quarter. We'll see. And the Atlanta Federal Reserve, they actually took down their expectation for second quarter GDP growth last week before they had announced the first quarter GDP. The Atlanta Federal Reserve was estimating 0.24% increase or 2.4% increase in the second quarter. They reduced that to 1.1% in the second quarter. But given what we saw in the first quarter, which was impacted again by those net imports, and I would just have to argue if we were to hit a 1.1% kind of steady state GDP growth in the second quarter, that'd be pretty favorable. So inflation expectations last week, no change. It is still at 2.27% expected over the next 10 years. Fed funds. We do have a Federal Reserve meeting. It is tomorrow, and then there will be a rate announcement on Wednesday. The odds built into the future market, no change. 98% odds probability there will not be a decrease in rates on Wednesday. Then if we take a look at the December numbers, the odds of two or more decreases at the end of the year, by the end of the year, went from 89% down to 78%. A little bit surprising. I have to guess that's investors looking through that negative GDP number. But now there's a 42% probability that we'll get 3 cuts by the end of the year. Lastly, in terms of data last week, corporate earnings, this is a huge positive. So sustainability, not sure, but the first quarter earnings, S&P 500 companies have been really good. So we have 72% of the S&P 500 have reported first quarter earnings. 76% of those companies, they beat expectations in terms of earnings. So the expectation now for the first quarter is that we will average, S&P 500 companies will average an increase year over year of 12.8%. Now coming into the quarter, it was as low as 7.2%, and just last week, the average was 10.1%. So now the expectation for first quarter is earnings per share, S&P 500 companies up 12.8%. So that is very strong. Last week, so with all that economic activity, all those data points, corporate earnings, very good week in the equity markets. S&P 500 up nearly 3% at 2.94%. And that's without being led by the Magnificent Seven or tech. NASDAQ was up a little more than that, up 3.4%. But the Russell 2000 small cap up even more, 3.24% versus the S&P at 2.94%. So in the U.S., you had growth up strongly last week, 4%. Value was up 2%. And large, small, hardly any difference. Large up 3.0%. Small up 3.2%. So now on a year-to-date basis, as bad as things have looked, a lot of uncertainty still in front of us, but the S&P 500 as of Friday, down only 2.91% on a year-to-date basis. So I would have to argue that's probably a lot better than a lot of investors kind of feel the market has performed. So in last week, we also had the developed markets ex-US up about same as the S&P 500, pretty close. It was up 2.99%. In emerging markets, also up 3.3%. So the only down metrics last week, really fixed income down a little bit. It wasn't bad. The 2-year yield rose 9 basis points. The 10-year rose 7. So the Bloomberg U.S. Aggregate Bond Index was down 30 basis points last week. So Let's take a look at the economic data hitting this week in a much more sparse calendar than we had last week. Today we had Monday, ISM Services PMI. The consensus is 50.6. Last month, the month of March, it was 50.8. So 50.6 would barely be above that demarcation line between expansion and contraction, which is 50. So we'll see. We also have the Fed rate decision, already went through that. It's expected to be no decrease, so we'll stay in that range of 4.25 to 4.5%. And then lastly, the initial jobless claims, a weekly number that comes out. The expectation has risen after last week's upside negative surprise. So the expectation is we will see 232,000 new claims versus the 241 reported last week. So that's it for today's economic update this week. We thank you very much for attending, and we'll look forward to seeing you next week. Thank you.